You have been lied to. The lie is so fundamental, so deeply embedded in the language of business and success, that you've never thought to question it. The lie is that the goal is profit. You've been psychologically conditioned to see the bottom line of an income statement as a finish line, a victory banner, the final and most important metric of success. This is a dangerous illusion. For most of the world, for most corporations, and for most investors, profit is not a destination. It is a graveyard. It is a cognitive trap, a place where capital goes to die a slow, inefficient death. The ambition that drives you, the relentless pursuit of profitability, has anchored your mind to a half-truth, and in the world of generational wealth creation, a half-truth is the most effective lie of all. The real story, the one that separates the merely successful from the monumentally wealthy, begins where the income statement ends. It is the story of what happens next. Because $1 of profit, sitting inert on a balance sheet, is a wasted soldier. It is potential energy that is never converted into kinetic force. It is a seed that is never planted. The world is filled with profitable companies that create no real wealth for their owners over time. They are prisoners of what we can call the institutional imperative, a psychological virus that forces them to squander their hard-won capital on misguided acquisitions, on bureaucratic bloat, on ill-advised expansions outside their circle of competence, or, perhaps most insidiously, on simply doing nothing at all, letting the silent cancer of inflation eat away at their victory. They win the battle of profitability, only to lose the war of compounding. Warren Buffett's $90 billion fortune was not built on this lie. It was built by declaring total war on it. He recognized, earlier and with more clarity than almost anyone in history, that the act of generating profit is merely the first and arguably the easiest step in the equation of wealth. The true genius, the master algorithm that powers the entire Berkshire Hathaway empire, is a system built around one single-minded obsession: the intelligent, rational, and relentless reallocation of capital. He didn't just seek out profitable businesses, he sought out businesses whose profits he could rescue. He built an ark for stranded capital, a conduit to move money from places where it was merely comfortable to places where it could become truly powerful. This is not a video about a stock-picking trick. This is a complete deconstruction of Buffett's most foundational and least understood mental operating system. It is the master blueprint that makes all his other mental models, the economic moats, the circle of competence, Mr. Market, truly lethal. We are going to deconstruct the perpetual money machine. This is a cognitive architecture designed for one purpose: to transform a disconnected collection of profitable assets into a single, cohesive, self-fueling, and unstoppable engine of compounding. We will reveal the three core pillars of this system. Pillar 1. The cash conduit principle, the art of identifying and acquiring businesses that are structurally designed to gush cash. Pillar 2. The centralized rationality engine, the ruthless, unemotional operating system for deciding where that gushing cash goes next. And Pillar 3. The compounding flywheel effect, the physics of how this machine, once running, creates a gravitational force that makes its own growth inevitable and exponential. Prepare to uninstall the profit illusion and install the master blueprint for true, systemic wealth creation. The first pillar of Warren Buffett's perpetual money machine is the most crucial because it is the source of all its power. It is the system for acquiring the raw fuel that the entire engine consumes. This is the cash conduit principle. To understand this principle is to fundamentally rewire your brain about what makes a business good. The average investor, the average MBA, is taught to look for growth. They look for rising revenues, expanding market share, exciting new products. These things can be good, but they are not the primary variable in Buffett's equation. Buffett is not looking for growth. He is looking for cash. Specifically, he is looking for businesses that generate vastly more cash than they consume. These are not just businesses. They are conduits. They are pipelines designed to transport capital from the hands of millions of customers directly into his control center in Omaha, with as little leakage as possible along the way. The perfect illustration of this principle the foundational case study for the entire Berkshire Hathaway empire, is a small, unassuming company of confectioners, See's Candies. In 1972, Buffett and Munger, through blue-chip stamps, acquired See's Candies for $25 million. On the surface, it looked like a terrible deal to the spreadsheet-obsessed analysts of the day. The company's net tangible assets, the book value of its factories and inventory, were only $8 million. Buffett was paying a $17 million premium, a price that seemed ludicrous. But Buffett wasn't buying the tangible assets. He wasn't buying the factories or the inventory, he was buying the brand. He was buying the feeling a customer in California had when they gave a box of See's for Christmas. He was buying a miniature economic moat, an intangible fortress in the minds of consumers that allowed See's to do something magical. That magic was the ability to raise its prices every single year just a little bit without losing customers. This small, incremental pricing power, combined with a business model that required almost no new capital investment to function, created the perfect cash conduit. A normal business, a manufacturing company or an airline, when it wants to grow, must make enormous capital expenditures. It has to build new factories, buy new planes, invest billions of dollars just to stand still against depreciation, let alone expand. That cash, that profit, is trapped. It must be reinvested back into the business just to maintain its competitive position. It is not free to be used for other purposes. See's Candies was the opposite. To sell more candy, they didn't need a revolutionary new factory. They needed a slightly bigger kitchen. The capital required to grow was minuscule. The business was, in Buffett's own words, an quote, economic franchise. It was a machine that took in $1 of capital and spit out torrents of cash for decades to come. Let's look at the numbers, because this is where the sheer power of the conduit becomes terrifyingly clear. Berkshire paid $25 million for See's. By 2011, nearly 40 years later, See's had generated over $1.6 billion in pre-tax earnings for Berkshire. And here is the critical point, the very essence of the cash conduit principle. To generate that $1.6 billion, the business only had to reinvest a paltry $32 million back into itself. Think about that. $32 million in, $1.6 billion out. The rest, a colossal river of cash, flowed unimpeded directly to Omaha. It was rescued capital. It was liberated profit. This is what Buffett was buying for his $25 million purchase price. He wasn't buying a candy company. He was buying a perpetual bond that paid an ever-increasing coupon, a pipeline that would deliver the seed capital for his empire for the next half-century. That money, the cash gushing from See's, was not emotionally attached to the candy business. Buffett and Munger felt no sentimental obligation to use the profits from See's to build a bigger, better candy empire. They didn't try to expand it nationally, a move that would have required massive capital and likely failed. They understood that the genius of See's was its geographic moat in California. Instead, that candy money, now free and clear, was put to work in entirely different universes. It might have been used to buy shares in the Washington Post. It might have been used to increase Berkshire's stake in Coca-Cola. It might have been used to fund the expansion of their insurance operations. The cash conduit had done its job. It had extracted capital from a profitable, stable but slow-growing enterprise and delivered it to the master allocators who could deploy it into opportunities with far greater potential returns. This mental model requires a profound psychological shift. You must stop seeing businesses as independent entities and start seeing them as components in a larger machine. Some components are designed to be sources of power. Other components are designed to be users of power. The fatal mistake most corporations and investors make is failing to distinguish between the two. They try to force their cash conduits to become growth engines, pouring money back into a business that has no intelligent way to use it, achieving mediocre returns, and destroying shareholder value in the process. This is the corporate equivalent of the activity trap. It is action for the sake of action, growth for the sake of growth. Buffett's genius was to create a system that allowed for specialization. See's Candies had one job: make delicious candy, maintain the brand, and send the cash to Omaha. That was its purpose within the Berkshire ecosystem. It didn't need to worry about acquisitions or stock buybacks or any of the other duties of capital allocation. That function was outsourced to the central brain, to Buffett and Munger, who could survey the entire economic landscape and find the absolute best home for that next dollar of rescued profit, regardless of its origin. To truly install this mental model, you must learn to diagnose the capital intensity of any business you analyze. You must ask the killer question: if this business generates $1 of profit, how much of that dollar must be chained to the balance sheet to maintain its competitive position, and how much is truly free? You must learn to see the invisible ball and chain of capital expenditures that holds most companies down. When you look at an airline, you must see the billions of dollars in aircraft that are constantly depreciating, requiring a perpetual cycle of reinvestment just to keep flying. The profits are an illusion. They are already spoken for. When you look at a complex manufacturing firm, you must see the endless spending on new plants and equipment needed to keep up with technological change. The cash is trapped. The cash conduit, however, is different. It is a business like See's, or a brand like Coca-Cola, or a local newspaper in its heyday like the Buffalo News, another one of Buffett's legendary cash conduit investments. In 1977, he bought the Buffalo newspaper for $32.5 million. It was a local monopoly. It had pricing power. It required very little capital to run. And it proceeded to gush cash for decades. Cash that was siphoned off and deployed elsewhere in the growing empire. The cash conduit principle is the art of buying a goose that lays golden eggs, and then having the discipline not to waste those golden eggs on building a fancier nest for the goose. It is the art of recognizing that the highest and best use of the gold is almost certainly somewhere else entirely. This requires you to divorce your analysis of a business's operating performance from its potential as an investment. A business can be run beautifully, it can be profitable, it can be a pillar of its community, but if it is a capital sponge, if it consumes every dollar it earns just to stay in the game, it is a terrible component for a perpetual money machine. It is a source of drag, not a source of power. To build your own machine, you must first find your conduits. In your own life, this might not be a candy company. It might be your high-income profession. Your job as a surgeon or a lawyer or a programmer is a cash conduit. It generates income far in excess of what you need to maintain your professional skills. The mistake most people make is that they allow that surplus cash to be squandered, to be absorbed by lifestyle inflation or inefficient, unfocused investments. They fail to consciously and deliberately channel it towards a centralized allocation engine. They let the cash leak out. Buffett's first pillar is the construction of a leak-proof system. Identify the sources of surplus capital, whether they are wholly owned businesses, dividend-paying stocks, or your own salary. Recognize them for what they are, the fuel. And then build a system to transport that fuel, cleanly and efficiently, to the second and arguably most important part of the machine. The engine room, where the real decisions are made. This brings us to the second pillar of the perpetual money machine. Once the fuel has been sourced and transported from the cash conduits, it arrives at the core of the system. This is the centralized rationality engine. This is the brain, this is the governor. This is the ruthless, unemotional, and relentlessly logical operating system that determines the fate of every dollar of rescued capital. If the first pillar is about sourcing power, this second pillar is about the intelligent application of that power. It is here that Buffett's genius for capital allocation is made manifest, and it is a function of both intellectual rigor and a deliberately engineered organizational structure. The structure of Berkshire Hathaway is not an accident. It is a design. It is a corporate architecture created for the sole purpose of optimizing the reallocation of capital. Think of it as a hub-and-spoke model of rationality. At the center, in Omaha, you have the hub, the minds of Warren Buffett and Charlie Munger. This is the centralized rationality engine. All the surplus cash from the dozens of disparate operating companies, the spokes, flows to this hub. The profits from See's Candies, the insurance premiums from Geico, the earnings from the BNSF Railroad, they all mingle in a single colossal pool of capital controlled by two men. This structure is a weapon. It is a cognitive fortress against the psychological biases that plague almost every other corporation on the planet. In a typical conglomerate, the CEO of the candy division would fight tooth and nail to keep the profits from his division. He would invent new projects, propose expansions, argue for acquisitions within the candy industry. His ego, his career, his identity are all tied to the growth of his specific silo. He is emotionally and professionally incapable of admitting that the best use for his profits is in a completely different industry, like railroads or energy. This is the institutional imperative at its most toxic. It leads to what Buffett calls diversification, where companies squander capital on mediocre projects within their own industry, simply because they lack the mechanism and the psychological fortitude to move it elsewhere. Berkshire's structure annihilates this problem. The CEO of See's Candies has one job: run the best candy company in the world and send the cash to Warren. He is not in the capital allocation business. That responsibility is stripped away from the operational level and centralized at the hub, where Buffett and Munger can look at the entire landscape of opportunities with a completely agnostic eye. They have no emotional attachment to the source of the capital. $1 from See's Candies is no different from $1 from Geico. It is simply a raw unit of economic power, and their sole job is to deploy that unit where it will compound at the highest possible rate over the long term, within their circle of competence. So what does this engine do? How does it decide? Buffett has a clear mental framework for the 5 possible uses of capital. First, a company can reinvest in its own operations. This is the first and best option, but only if the returns are extraordinary. Think of a company like Costco, which can reinvest its earnings in opening new stores that generate fantastically high returns on capital. Buffett loves this, but it is exceedingly rare. Most businesses cannot reinvest large sums of capital at high rates. Second, a company can acquire other businesses. This is Buffett's preferred method when internal reinvestment opportunities are scarce. He uses the cash from his existing conduits to buy new conduits, or businesses with high reinvestment potential. This is the primary function of Berkshire's engine, using the cash from the spokes to buy new spokes. Third, a company can pay down debt. This is a sensible option if the interest rate on the debt is higher than the potential returns from other uses of the capital. It's a matter of simple mathematics. Fourth, a company can buy back its own stock. This is a fascinating and often misunderstood option. Buffett sees it as a form of acquisition. When Berkshire buys back its own stock, it is increasing its ownership percentage in all of its underlying businesses. It is a decision that only makes sense when the stock is trading for less than its intrinsic value. In that case, buying back your own shares is the most intelligent acquisition you can make. You are buying a business you know intimately at a discount. Fifth, and last, a company can pay a dividend. Notice where this falls on the list. For Buffett, paying a dividend is an admission of defeat. It is a signal from management that they have run out of intelligent ideas for how to deploy the company's capital. They are essentially saying, "We can't find a way to earn a good return on this money, so we're giving it back to you, the shareholder, to figure it out for yourselves." Berkshire Hathaway has famously never paid a dividend because Buffett has always believed, with good reason, that he can do a better job of reinvesting that dollar of profit than his shareholders could. He is, in effect, running a massive, tax-efficient and zero-fee investment fund for his shareholders, and the price of admission is trusting his centralized rationality engine. The most brutal and brilliant example of this engine in action was not an acquisition, but a divestiture. It was the slow, painful, and utterly rational execution of the original Berkshire Hathaway textile mills. When Buffett took control of Berkshire in 1965, it was a failing New England textile business. The industry was in terminal decline, facing overwhelming foreign competition. For years, Buffett and his manager, Ken Chase, worked tirelessly to keep it afloat. They improved operations, they bought more efficient looms, they fought for every scrap of profit. And they did generate small profits. But here is where the rationality engine kicked in. Buffett recognized that any profit the textile business generated had to be immediately reinvested into the business, just to stay competitive. It was a capital sponge. A dollar invested in a new loom might save a few cents in operating costs, but it would never generate the kind of returns he could get elsewhere. The textile business was a source of capital drag. So while he was publicly trying to save the textile business, he was privately and systematically using every dollar of profit it generated and every dollar of its depreciating assets as seed capital for his new ventures. He was using the dying body of the old Berkshire to fund the birth of the new Berkshire. The cash from the looms was used to buy insurance companies like National Indemnity. It was used to buy See's candies. It was a slow, multi-decade process of capital transfusion, moving the economic lifeblood from a dying patient to a series of healthy, growing children. Finally, in 1985, he shut the textile operations down for good. It was a painful decision. It meant laying off loyal employees. But it was the only rational decision. To keep pouring capital into a business with no future, simply out of sentimentality or a misplaced sense of loyalty to the past, would have been the ultimate failure of a capital allocator. It would have been a betrayal of his duty to his shareholders. This story is the central IZED rationality engine in its purest form. It is the ability to look at an asset, even one that bears your company's name, and ask the cold, hard question. Is this the best possible home for the next dollar of capital, or is there a better home somewhere else? 99% of managers are incapable of this level of detachment. Their ego, their history, their emotions get in the way. Buffett's deliberately engineered system of centralizing capital allocation at the hub, away from the emotional attachments of the spokes, is what allows him to maintain this superhuman level of rationality. To install this pillar in your own decision-making, you must create your own version of this structure. You must separate the act of earning money from the act of deploying it. When you receive a salary, or a bonus or a dividend, that money should not be considered your money in an emotional sense. It should be transferred to a separate mental and, ideally, physical account, your rationality engine. From this account, you must evaluate all possible uses of that capital with the same agnostic, unemotional rigor as Buffett. Should you pay down your mortgage? Should you invest in your own business? Should you buy an index fund? Should you acquire a new skill? Each option must be weighed against the others on the basis of its potential long-term return. You must fight the urge to simply plow money back into the thing that generated it. The source is irrelevant. The only thing that matters is the destination. This is the discipline at the heart of the machine. It is the relentless search for the highest and best use of every single unit of capital, a search that is unclouded by ego, sentiment, or the dead hand of the past. It is the engine that turns the raw fuel from the cash conduits into the unstoppable force of compounding. And that brings us to the third and final pillar of the perpetual money machine. We've sourced the fuel through the cash conduit principle. We've processed it through the centralized rationality engine. Now we witness the outcome. This is the compounding flywheel effect. This is where the laws of mathematics and physics take over, transforming the machine from a merely effective system into an exponential self-accelerating force of nature. A flywheel, in mechanics, is a heavy wheel that takes a great deal of effort to get spinning. But once it is in motion, its own momentum makes it easier to keep it spinning, and each additional push adds to its speed not linearly but exponentially. It stores energy. Buffett's perpetual money machine is a financial flywheel. The first few decades were the hard part. It was the slow, arduous process of getting the wheel to turn. It was using the small profits from a dying textile mill to buy a small insurance company. It was using the modest cash flow from that insurance company to buy a small candy company. Each transaction was a push on the flywheel. The cash from See's Candies bought shares in the Washington Post. The dividends from the Washington Post combined with insurance float bought a bigger stake in Coca-Cola. The dividends from Coca-Cola, now a much larger stream of cash, combined with the profits from a dozen other wholly owned businesses, were used to acquire entire companies like the BNSF Railroad. Do you see the pattern? The machine is feeding itself. The outputs of one cycle become the inputs for the next, more powerful cycle. The initial pushes on the flywheel were measured in millions of dollars. By the 21st century, the pushes were measured in tens of billions of dollars. The momentum had become staggering. This flywheel effect has a profound psychological consequence. It fundamentally changes the nature of the problems you have to solve. In the beginning, the problem is scarcity. Where do I find the capital? How do I find enough good ideas? In the later stages, the problem becomes abundance. The machine generates such a colossal amount of cash, tens of billions of dollars every single year, that Buffett faces the challenge of deploying these enormous sums intelligently. This is what he famously refers to as elephant hunting. It's no longer worth his time to look for deals worth a few $100 million. They are too small to move the needle. A small push on a massive spinning flywheel has no discernible effect. To accelerate the flywheel further, he needs to apply immense force. He needs to find elephants' acquisitions so large they can absorb billions of dollars of capital at once. The purchase of the BNSF Railroad in 2009 for $44 billion is the ultimate example of the flywheel in action. Berkshire's machine was generating so much cash that he needed to find a business that was big enough and capital-intensive enough to be a new, massive home for that money. BNSF was perfect. It was a durable, moat-like business, an essential artery of the American economy. And it was a business that could intelligently reinvest billions of dollars every year in maintaining and upgrading its tracks and equipment, all while earning a decent return on that investment. In a way, BNSF became a new component of the machine itself. It was both a cash generator and, unlike See's Candies, a capital consumer. It provided a useful and profitable place for Berkshire to park the torrent of cash being generated by its other businesses. This is the genius of the mature system. It becomes a balanced ecosystem of cash conduits and intelligent capital sinks, all orchestrated by the centralized rationality engine. The flywheel effect also requires a specific psychological temperament, one that was covered in a previous documentary but is critically relevant here: a perpetual time horizon. The physics of compounding only works over very long periods. The flywheel's acceleration is imperceptible day to day, or even year to year. Its true power is only revealed over decades. This is why Buffett can sit, sometimes for years, on a mountain of cash, over $100 billion at times. This sight drives Wall Street analysts insane. They scream, "Deploy the cash, do something, anything." They are prisoners of the short-term clock, the activity trap. They don't understand the flywheel. Buffett understands that the single most destructive thing he could do to the machine is to make a bad decision just for the sake of action. A bad acquisition, a diversification, is not just a loss of capital, it is a source of friction on the flywheel. It slows the momentum. His willingness to do nothing, to wait patiently for the right pitch, for the fat elephant to wander into his sights, is not a sign of inactivity. It is the ultimate act of discipline. It is the act of protecting the integrity of the compounding machine above all else. He is the guardian of the flywheel. To install this third pillar, you must embrace the physics of compounding in your own financial life. You must internalize that the early years are a grind. Getting your own flywheel of savings, of investments, of business profits, to make its first slow, creaking rotation is the hardest part. You will be tempted to get discouraged. You will be tempted to tinker, to chase short-term gains, to abandon the process. This is a fatal error. You must think in decades. You must automate the process. Every dollar of investment, every reinvested dividend, Every contribution to your retirement account is a small, consistent push on your personal flywheel. For years, the results will seem unimpressive. And then, one day, you will wake up and realize that the momentum has taken over. The earnings from your capital will surpass your own contributions. The machine will be funding itself. The wheel will be spinning with a force that seems disconnected from your own small pushes. That is the moment you have achieved financial gravity. That is the compounding flywheel effect. The three pillars, the cash conduit principle, the centralized rationality engine, and the compounding flywheel effect, together form the blueprint for the perpetual money machine. It is a system for sourcing capital, intelligently deploying it, and allowing the laws of compounding to create an exponential outcome over time. It is the master algorithm that has been running silently in Omaha, Nebraska for over 50 years, turning a small, failing textile company into a $90 billion fortress of wealth. This is the real secret of Warren Buffett. It's not about a stock tip. It's not about a magic formula. It is about a superior cognitive architecture, a better designed machine for thinking about and acting on the process of wealth creation. And this blueprint is now yours to install. You must begin by identifying your cash conduits. Then, you must build a ruthless, centralized system for reallocating that cash. And finally, you must have the patience and the discipline to let the flywheel spin, protecting it from your own worst instincts for decades. But this blueprint, this three-pillar machine, has a fatal vulnerability. Its engine, the core of rational allocation, can be instantly corrupted by a single cognitive poison: noise. The constant barrage of market forecasts, breaking news, and expert opinions is a direct assault on the patience and clarity required to operate this machine. So how did Buffett build a psychological fortress around his mind, ensuring the engine runs on pure logic, not the insanity of the crowd? He engineered a hidden operating system for systematic, deliberate ignorance. It's called the noise cancellation protocol, and it is the silent guardian of the money machine. To deconstruct that psychological fortress and install its three pillars in your own mind, click the video appearing on your screen now.